Seuraava aiheemme, Light Industrial is the Newsecin, ei ole saanut otsikkoaan vain viimeisten unihiekkojen karkoittamiseksi. Ovatko pienteollisuuskiinteistöt todellakin markkinoiden kuuminta hottia? Siitä ottaa selvää Newsecin Head of Capital Markets Simo Vilhunen. Ole hyvä, Simo.
Kiitos paljon, Tutta. Thank you, Tutta. We will kick off the next section of the program with a presentation from Anita Simaza, who is the Head of Logistics and Industrial for Nordics and Baltics here at Newsec. Anita has more than a decade of experience of pan-European logistics, and before starting her current role from BNP Paribas Real Estate as well as Prologis. Anita will give a presentation of the pan-European logistics market with a special focus on light industrial market, as that has become extremely appealing for investors for a couple of years already. So please join me warmly welcoming Anita.
So pleasure meeting everyone today, and we'll look at specifically light industrial as part of the overall logistics sector and why it's emerging as a very interesting phenomena in the current cycle. And the best way of doing that, I thought, would be to look at the total market and how light industrial fits into that, and then go into a little bit of a detail on the light industrial. But here we can see on this slide the total commercial real estate performance for 2021, and as part of that, logistics and industrial sector. So on the left side, we can see that total real estate volume reached about 273 billion, so up on a previous year, but still a little bit lower than compared to the previous peak year. But interestingly, is the logistics, which is the dark blue line at 65 billion. It's out of all the asset classes in commercial real estate, it recorded the steepest increase year on year, is about a quarter of the total commercial real estate volume, and it's about half up from the previous year. So it's really exceptional results. And when you compare it to offices and retail, then yeah, when you see compared to retail, it's about 76% higher than retail. So it's really exceptional performance for the total sector of logistics and industrial. And when we look at the logistics and industrial a little bit into the more detail, you can really see on the chart here on the left how really significant the increase in the total volume was last year. And when you look at the deal flow, there isn't one, two or three deals that drove the market to this performance. It really is a variety of single and portfolio deals that accumulated to this total performance. And in terms of country performance, we can see on the right side here in the chart that it's really in every single country the performance is up. There's no real outlier. There's a little demand from investors across all of the countries, and the outstanding performance, perhaps to say, is in total volume terms is UK, really at 61% up, but in volume in euro terms, it's a big mover for Europe. And then the other one to mention is Sweden, where really significantly up 79%. So then moving on to the pricing of logistics and also looking at how that compares to the commercial real estate in total, because that is quite interesting as well. And we can see on the top side, and these are the average yields, so it depends on which markets you include in the averages, but in the markets included, total office is at 3.2% in the green, and then total logistics, the average is 3.6%. So the spread is narrowing, it's about 40 basis points, but it is important to note that in Europe, office is still more expensive, as in the 40 basis points. We have a number of investors, particularly from America, where in America it's actually in reverse, where logistics yields are lower than offices. So we have buyers present in the market who already witness logistics lower than office yields. And then the bottom, where we're really starting to get into more detail with the yield performance between grade A, as in logistics, versus last mile, and last mile will encompass light industrial and urban locations. And you can see really the differential here, where the urban is really very sought after. There is evidence across the markets where pricing is very, very strong for a number of reasons that we will speak just in a couple of minutes. But the yields are very low for logistics. They're continuing to go down. And it's really the occupational strength of the market based on the demand drivers that's driving the investment performance. So spotlight on light industrial, and we saw a couple of weeks ago the headlines that made around the world where Blackstone is planning to recapitalize Mileway. Mileway is the last mile platform, and they're quoting in the press about 21 billion. It really is an outstanding deal, and at 21 billion, last year it would have been about half of the total investment volume. In 2021, it would have been about a third of total investment volume. So it is really an outstanding deal. And so how did we get to this position of looking at this at such big scale? And so, and the question is really also sort of what is last mile? And last mile is essentially it's a step in a supply chain where it's the final step to the delivery to the consumer, and you can undertake that from within the city and you can undertake that from outside of the city, but it's the last step in a supply chain. And we also have an estimation now from Prologis, and in terms of the occupier demand for last mile, it is estimated that online companies nowadays spend about 100 basis points of their revenue on logistics rents versus 25 to 35 basis points for traditional supply chain 10 to 20 years ago, and this estimate comes from Prologis. So you can see that occupiers really do spend more money on their supply chains. They want to be closer to the consumer, and it is really as an answer to the e-commerce, because e-commerce, the way the occupiers compete with each other and the way the businesses compete with each other is in a speed of delivery, which means they want to be closer to consumer. And we have this phenomena of the rise of rapid delivery services, particularly in the food industry, so perishables like Get Here, Flink, Gorillas, and so forth. And so the question is, how do these occupiers / businesses, how can they get closer to the consumer? Are you going to the urban cities near the urban areas? And then one of the things that I think would be interesting to look at, because it really comes into play also for light industrial, it's the replacement cost of developing, which then directly comes into the place of the replacement cost of an existing building. And why existing buildings are so well maintained and why they will continue to be well maintained. And there are a variety of variables that come into play why we currently are experiencing record high replacement costs. Firstly, the construction materials, the cost of them are up. It's estimated that it's about 18% up in the last year. And it's quite hard to pinpoint exactly which material, because when I speak to developers, they say that it's across the board in terms of materials, so it's not just one or two elements. The second part is land prices. It's something we've seen across Europe, and it's very hard to pinpoint because there's no statistic really to say where the land prices are, but the estimation is that it's about 40% up in core European markets, and that's both Western and Eastern Europe, but it's in a core sort of logistics markets, it's 40% up, which is phenomenal increase. And then you look at some markets, particularly closer to urban areas like in Germany and in Netherlands, where it's doubled and sometimes even close to tripled in terms of land prices. And it's really coming from the fact that, there's a lot of competition between developers. There's more focus on brownfield sites from an ESG point of view, instead of building on greenfield, and being also closer to the consumer, which is what the occupiers wish to do. So land prices are under pressure of going up. It's one of the things we do not produce. We have the land, what we have. And thirdly, we have the low unemployment, and that's just, it's not getting any better, and that's the truth. And we see on the right side where, the European average from Eurostat is 6.4%. It's the record low level that Eurostat have ever measured. And when we look at this map, for example, the biggest logistics markets, Germany, UK, France, Poland, it's very, very low levels. It's very hard to find employees to work in warehouses, and also hard to find employees to build warehouses. So it's when you put that together with effects from corona virus, so restrictions on self-isolation, etc., you take the low unemployment plus the home sitting, if you like, it's just very hard to find employees. And lastly, the building specifications are getting more sophisticated, with high standards, e-commerce needing more, for example, automation and a more sophisticated building quality and the layout. And you're putting also some environmental aspects on top of that. So the specifications are being more sophisticated, which is rising the costs. So overall, we are having record high replacement cost, and also a longer delivery for buildings, because you're waiting for the construction materials and you're also doing the best that you can with managing labor. So, and that is another backdrop that sort of helps a bit of a spotlight on light industrial, because of these buildings are in urban, they are not the newest, but they are in many cases very well maintained, and they will, in my opinion, continue to be well maintained from a variety of points of views. Looking really why it's sort of, it's so appealing, and I think it's interesting to note that there are new drivers for light industrial in a current cycle that are not really related to how the light industrial buildings are used historically. And in part is because, investors looking at the logistics industrial asset class are following occupier demand, and they are searching for higher returns. Light industrial are historically, smaller lot sizes, more asset management intensive, because you have smaller local regional occupiers. But there's a lot of potential in these buildings because of the price gap as well. And some of the drivers that are going for the light industrial, and firstly, it's the land price. What we saw generally happening with land prices, but what we have with light industrial, with being in urban locations, they have higher alternative use value to another use, and a lot of times it could be commercial, but it could be also residential. Secondly, because of the first reason, we have a diminishing stock, and that's really coming from the rezoning of the industrial sites to other priorities, specifically residential. And that is something that you see really across Europe, where the priority of municipalities is to build new housing, and you look at already what you have land that's all been artificially already developed, and that's basically you're looking at industrial. And then thirdly, and that's coming really from the current sector, which is you have a more varied and therefore increased occupier demand, where you have the companies for e-commerce, whether it's a 3PL or a user, they want to be closer to the consumers. So you have more varied demand coming into these properties. And so as a result, why it is so appealing, there are three reasons in my opinion. You have the high and increasing land value. You have the rental growth, which is witnessed from more varied occupier demand, reducing stock. And then as a result, you also have the increasing capital values from the first 2 points, but also because there's more demand into the sector. And so the question is, how do we access this sector, because of the the challenges of it being smaller lot sizes and more local occupiers, more asset management intensive, smaller units. And what we see is that if you look at some of the examples of strategies of how the capital has been finding it, what I see is that the common theme is that a lot of the times, if not most of the times, investors are working together with specialist managers on the ground, or they are establishing their own specialist platforms. And then there are a variety of strategies of how different companies are doing that. So for example, M7, they are one of the most well-established, oldest manager of multi-tenanted commercial real estate in Europe, and that will include light industrial and offices as well, and they're pan-European. Then you have the top centre Capital Industrial. They focus only in one market, which is Greater London. They're very specific about that, and they're very specifically targeting light industrial and what they call studio properties, so smaller lot sizes. And that could be single assets, could be park locations, but it's very specific in what they are doing within that city. And then you have, for example, a platform that is established by AEW called ULIS. It's focused on the three countries, and they're targeting urban logistics and light industrial. So they are going for both infill and sort of suburban locations, if you like, where they can develop facilities that are good for urban distribution in sort of suburban locations. Top, bottom, sorry, not top, bottom, just one or the other. The bottom left, we have from Mark, they've established a platform called Crossbay in a variety of markets, and they're growing, and they're really targeting single user distribution centers near gateway cities. So it's the urban logistics, but not really so specifically on a light industrial sector targeting. And then you have Thor Lodges from Thor Equities. Thor Equities is a specialist in urban real estate, and they established Thor Lodges for a specialist for infill properties in major logistics hubs, focusing on the logistics industrial sector. So they are, buying a lot of light industrial properties because those properties really are in, the most in abundance in urban areas. And then you have another sort of way of doing it, which is the Edmund de Rothschild European Industrial Fund. It is a fund that, it's one fund that they manage, and that's focusing again on urban industrial logistics. So they'll be buying logistics buildings, light industrial facilities in urban locations or close to, very close to urban locations in suburban locations. So there are a variety of strategies. A lot of these strategies are aggregation strategies, and it is very interesting to see more of these also come through, and a lot of it is in a single country or single market basis, but they're with a few sort of pan-European strategies. And clearly the one that we saw earlier with Blackstone recapitalizing Mileway, it's really a premier deal, if you can say so, in terms of benchmark of where this is kind of heading. So with that, I hope it was an interesting presentation, and I look forward to any questions later on that you have. Thank you very much.
Thank you so much, Anita, for the exciting, interesting presentation. I have a few questions here for the presentation, but also I have the pad here if we get some very interesting questions from the audience as well from online. You mentioned rental growth for light industrial properties, so could you elaborate on that a bit further and maybe with some examples?
Yes, thank you, Simo. And I think on the rental growth, if you look at the logistics side, across Europe, across the sort of the core Western and Eastern European markets, we see a headline rental growth in a low 7%. If you take into account other markets, like for example, Ireland, Portugal, Greece as well, then you're sort of between 3 to 4%. But that is for logistics, because that's the sort of the market that sort of statistically we are being measuring. And so, the driver for that is really sort of the competition, I guess, also between the developers or on the development side, because that's sort of, your alternative is a development. And since the replacement costs are rising, then the rents are also rising. And on light industrial, we don't really have a statistic because that's not something we're really measuring. But what I see is that consistently across, particularly the bigger cities, the rents are tend to surprise every single time upon a new letting. So if you're putting a vacant building into the market, most likely the landlord will be surprised as to what that level is going to be, and that level tends to typically be higher than what I would call a logistics rent. We just don't really measure it specifically, because there are so many variances between some of these submarkets, but it's a consistent sort of a phenomena, if I can say so.
Yeah, very, very extensive. How about kind of continuing from there, what type of occupiers are the most active in that segment?
Yeah, very, very good question. And the one statistic that I probably could mention on this one is probably from Germany, because it's we don't really measure or publish as to the types of occupiers that comprise the total take-up. But Germany is the one country where there is a published statistic about that. And so they measured that logistics companies, so 3PLs, together with retailers, whether wholesale or e-commerce, those two segments account about 75% of total take-up. And then the rest is part manufacturing and part others. So you can see that with 75%, with 3PLs and retailers, most of the demand is led by consumption and trade. And that really is the sort of the e-commerce element, because from one side you can say, well, to sell, we need to produce. But this is where we really can see the sort of the consumption element and the trade really taking up more space, which also came from the earlier note, which is that, you know, the companies are spending more money on their logistics rent than before, which is growing out their supply chains.
Yeah. And well, obviously ESG is a huge factor for the real estate as a whole. So how do you see that in light industrial specifically?
Yeah, that is a very good question. And I think there is a big difference between logistics and light industrial. And by logistics, I mean mid to big box, because A, you have a usually a different type of an owner, and B, you have a different type of an occupier. So it's easier, if I can say so, to build a logistics to ESG and upgrade an existing logistics building to ESG, because A, the occupier wishes for it, or the investor wishes for it. I think light industrial is very different because you have the affordability is just simply different. So from an occupier point of view, I don't really see occupiers driving it. And perhaps there are some isolated cases, but I do think it's more isolated. And so then you are looking at landlords driving it for light industrial, but I don't really see it as a sort of a consistent where you can really see that it's happening in light industrial. So light industrial is for financial reasons more than anything else, sort of not at the same speed as logistics, and practical as well, because we need to bear in mind that a lot of these buildings are 40, 50 years old. So upgrading that is much different than something that was built 10 years ago. So I think it's more sort of a driver from landlords and how they are going to do that. So that's definitely a differentiation that an owner of light industrial can do for their properties.
Yeah, thank you. I mean, we could talk for hours probably, such an exciting topic and segment, but it seems that the program of the whole seminar is kind of catching up. So thank you so much for the presentation and the Q&A. And obviously after the webinar, we're more than happy to help with any questions people may have. Thank you, Anita.
Thank you, Simo. Thank you, Simo.